Okay, Brent, we are live. Welcome everybody to Wall Street Reporter's next Super Stock live stream for today, December 17th, 2020. We got an exciting day for you today. We have, starting off with a Logiq. We have Brent Sun, the president of Logiq, with us today. The stock is running, making new highs, breaking out of a trading range. And I think it's in the $13 range, which is actually a lucky number. So we're going to find out what is next, and maybe the stock can go into the a different number, maybe like $40. We'll find out. So with that said, for anybody that's new to our program, again, our goal is to bring you stocks which we believe have 10x to 100x upside potential. Again, if you've followed our live streams over the past year, you've seen we've had a number of these stocks that have been 1,300%, 1,700%, 2,000%, and a whole bunch of 5x, 7x, 4x, all across the range. And of course, Logiq is performing very well. The stock started off in the $4 range back in, I think it was July. We're at a 3x right now, on the way to hopefully a 10x, right, Brent? We need a 10x for you to be, considered a potential stock. 100x would make you an official super stock, but 10x would put you on the right track. So with that said, what we're looking for is we're looking for companies which have they have three things going for them. Number one is they're going after massive multi-billion-dollar opportunities. They are right now at a key inflection point in their growth where things are about to take off in terms of revenues, corporate growth, development, where value is created, and most importantly, there are multiple catalysts in place which can drive that growth, create the value. So with that being said, I'm going to turn it over to Brent. He's going to share with you the latest presentation. We'll go through the Q&A. And again, it's your questions that make these events special. So please watch the presentation, ask Brent your questions, and then decide for yourself if Logiq is going to be our next super stock with that 100x upside potential. With that said, Brent, I'm going to turn it over to you and take it.
Great. Thank you, Jack. I'm Brent Sun, President and Executive Chairman of Logiq. I'm glad to be here today. I'm going to take you all through our presentation. Our standard disclaimer, which I will spare everyone from what could be a very lengthy read. Logiq, who are we and what do we do? Very simply put, we are an e-commerce enablement platform. We have two distinct business units, Logiq, which is e-commerce enablement for smaller businesses. And we've taken the approach of focusing on emerging markets. Our strongest one is Indonesia, which is located in Southeast Asia and is the fourth most populous country in the world. 260 million people and about 99% smartphone penetration, which is extremely important. We like to describe that business as a Shopify for mobile. And what I'd like to point out very quickly is, although Shopify is a considerably larger company, the similarities are such that what they do is enable small businesses to get online. The way that they get them online is through a website that can be enabled or is enabled for smartphones. When you look at emerging markets, it's actually a very low penetration of desktop and laptop computers. So creating a website that is optimized for a mobile phone really doesn't make sense. And so you have to have what's called a mobile solution, which we do. That's essentially our value add. And it's all we do on the Logiq side. Everything is mobile. So the key differences between us and Shopify are that, again, they focus on websites that can be accessed through a mobile phone. We focus on mobile websites that are built on the phone, accessed through the phone, and marketed by our customers to their customers via the phone. Our other business unit, Logiq, which we have a very considerable amount of things underway. And if you look at our news flow this past few months, you'll see that there's been an uptick in both M&A activity and news surrounding our entry into the ad tech and MarTech area, which I'll talk a little bit more about shortly. But we view that part of the business as a very strong growth driver going into 2021 and onwards. And as we start to announce a few more things that are impending, all the pieces will fall into place, and I believe that you'll start to see how the growth trajectory is positively impacted by that. We've actually benefited from what is considered now the new normal of working from home. Certainly the way that we purchase things in our daily lives. Just the mere fact that we're doing presentations online as we are here has really enabled our growth. And so we're very thankful for that. If you look around the industry and look for publicly traded peers, you'll find companies like Shopify, SEA Limited, Wix, Jumia, Amazon, Trade Desk, Magnite, and BigCommerce, which recently did their IPO. These are, of course, larger companies. There are not a lot of smaller companies such as ours. We do get the question, how do you compete against giants like these? It's from the beginning, 6 years ago, it's always been about positioning ourselves for either a future strategic investment or even an acquisition, which we have publicly stated numerous times we are open to. We certainly have had conversations around that. If you look at our annual revenue growth, we've grown pretty well since 2016. Earlier this year, we actually acquired what is now the Data Logiq business, which has been a good contributor to this year's revenues. We're on a trailing 12 months revenue run rate of about 43 million. Just to speak to the overall statistics for mobile commerce, which we really, which are the areas that we are focused around. If you look at the global m-commerce or mobile commerce market, it's unequivocally a huge market. Southeast Asia m-commerce has also been growing significantly and is an important part of our focus. And certainly the US mobile commerce market has been growing significantly as well. Going back to Southeast Asia, around 90% of internet users use smartphones, and there's around 300 million people in the region. So it is a huge area of focus and a huge opportunity for us being 100% mobile. Talking a little bit more about our platform, what we have here are what we call the 4 pillars of e-commerce or mobile commerce. So there's marketing and analytics, there's e-commerce services, there's mobile fintech or the ability to pay for things through the phone, and then there's the logistics component as well. This year has actually been a landmark year for us because we have now rounded out our product and service offering to where we now encompass all 4 of those pillars. So we've got a lot of exciting things happening and that have happened that will take us into the new year on a very exciting path. If you look at the lower middle part of the screen, you'll see integrations. What that means is we tie into every major global payment gateway, every major social media site, and the ones shown here are just a handful of them. There's in excess of 70 all in. So again, this year has been one of building and positioning. Going into next year, which is right around the corner, you'll really start to see that kick in, and we believe that the inflection point is right now. So the question is, why Logiq? Why would someone use us? What I wanted to illustrate here is how we have brought our solutions to an existing problem. Because within any problem, providing a solution to that represents an impact to your business. So one of the things that we viewed 4 years ago is that in the Southeast Asia region, what are some hallmarks that all the major cities there have in common? And if you look at the underlying population within these urban areas, it's significant. I live in New York. We've got 10 million people here. But if you look in Southeast Asia, you'll see some very highly populated cities. Indonesia, in Jakarta, the population base there is actually 34 million. Bangkok, Thailand, 17 million. Manila in the Philippines, 23 million people. And then Vietnam, in Hanoi, there's 8 million people. So you can see very readily that within these big population bases, what do you have? Well, you've got a significant amount of traffic. The two photos here are illustrating what those traffic jams look like. And I spent 13 years in Asia and only recently came back to the US a few years ago. I've spent upwards of 3-4 hours in a car in traffic just to go 10 miles. I would have been better off walking. So this problem is actually increasing as people start to make more money. They purchase automobiles, motorcycles, scooters, so the traffic only gets worse. So this type of problem begs a solution. So with the current new normal of today, in these areas, if you want to buy something through your phone, which most everyone does, are you going to get in your car or get on your scooter, get on your motorcycle, or are you going to order it through the app? So we've taken an approach where even things as simple as going downstairs from your office building and getting lunch could take upwards of an hour. So how do you solve that? Our solution is an app-based ordering, payment, and delivery platform where it takes an average delivery time of 14 minutes with us versus 45 minutes for our competitors. So why is that? Okay, so here in North America, for example, and we've all ordered from DoorDash or Grubhub or Uber Eats. People deliver to us in the car, so they've got to drive, pick up the meal, bring it back, park, and then interact with the customer to find out exactly where we live. That typically takes 45 minutes. It's no different in emerging markets. It's actually a slight bit worse, but they're using motorcycles and scooters. It still takes 45 minutes. We've implemented a foot-based solution. So we've got couriers in Jakarta who make the deliveries on foot. There's no parking of any vehicles, so they can make a delivery in an average of 14 minutes. So what does this do? This shortens the time. It makes things a lot more efficient and brings people back for future business. As we start to expand that and layer in more products and services and gain more name brand recognition, not only does it impact our business positively, but again, as I mentioned earlier, in terms of positioning, we look around the peer landscape, and there are some multi-billion-dollar valued companies and multi-billion-dollar publicly traded companies that would be potential acquirers or strategic investors into our business. So when we talk about partners and customers, the big question is always, all right, you guys are a small outfit. When you do due diligence as an investor, one would hope that you see signs of validation and credibility in terms of customers or investors or partners. What we see here are some of our global partners. ShopeePay, not a household name in North America, but their parent company, C Limited, which is listed on the New York Stock Exchange, has almost a $90 billion market value as of today. That's up from their IPO 2 years ago at $3 billion. Tech Mahindra, a global giant in the tech space, headquartered in India, $6 billion market value. Orange Business Services in the EU, almost a $30 billion market value. Quinn Street, Purple, Cox Media, Line. These are some of the names and representative customers and partners who have actually chosen our solutions for our various business products, literally just in the past year. So all of these names are within this past 10 months. Financial highlights. Again, as we've grown, we have seen a very nice trajectory with trailing 12 months revenues again at 43 million. However, We believe, and we have said this on our last quarterly conference call, that going into 2021 and 2022, we expect significantly higher revenues and, more importantly, improved gross margins. So the targets we've put out for next year and 2022 are 43 million and 67 million respectively. If you look at our gross margins for this year, and historically, they've been in the high teens. We expect to improve them by double going into next year, and then almost as much as a triple going into 2022. Now, although we talk about 2022, and some people might say, well, that's another year out. Typically, the way that stocks will trade is they will start to forecast in future revenues, especially when taking a discounted cash flow model. So if you want to look at where we're heading, one thing that I like to point out is the recent news. And as recently as September, we appointed Tom Furukawa as our Chief Executive Officer. So I stepped down into the president role and executive chairman. Unfortunately, I'm actually busier today than I was before Tom stepped in, but now I'm fully focused on Southeast Asia and leading the initiatives there. Tom's actually been in ad tech for 26 years, and he built the Yahoo platform for ad tech. He's also worked at IBM Tivoli. He was at Magnite, which is listed on the New York Stock Exchange, and he is a veteran and expert in ad tech and MarTech. In October, we brought Josh Jacobs onto our board of directors as an independent board director. He was previously president of Omnicom. It's one of the top 3 largest ad agencies in the world. Much like Tom, Josh is a 30-year veteran in digital advertising and marketing. And then last month, we announced the acquisition of Fixel AI. Fixel has not only brought in a critical component of our going forward plan, but also several customers that we have jointly gone after, and you'll be seeing more that will not only improve our revenues, but significantly enhance our gross margins. And so what you'll also see are some impending news items about building out that platform and why it's important going into the new year. So what do these announcements mean? In addition to getting companies online, enabling them to get their business from an offline basis into an online basis, in being on a mobile phone, having a presence, being able to market to their customers. The biggest challenge for them after they're online is getting customers to find them. So how do you do that? Well, that is through ad tech and MarTech. And so our entire evolution of onboarding and enabling customers who have been offline and getting them online is now greatly enhanced by being able to bring them solutions to better advertise, market their products and services, and be found, sell more, and sell better. You'll start to see a lot of that going into next year. So look forward to some big things. In terms of the stock, in terms of valuation, here what we see is a peer group that encompasses both e-commerce enablers that are not only focused here in North America, but also some in emerging markets. We've also layered in several companies that are key members of the ad tech community. So Shopify, I think most people are familiar with them. More notably, their valuation metric is a 60 times price to revenue. Trade Desk, which has had an incredible run and doesn't look to be stopping anytime soon, they're trading at nearly 60 times revenues as well. Magnite, where Tom once worked and helped build their business, is currently at 12 times revenues, but their stock is up double just in the past month. C Limited, that I mentioned earlier, 27x. Stone companies, they focus on emerging markets, specifically Brazil down in South America, also a big multiple. Wix, another e-commerce enabler, and then Jumia, which has a focus in Africa as an emerging market in terms of e-commerce enablement. What we see here is an average price to revenue of about 33 times revenues. And actually, if you take a lot of the other medium-sized companies, and I added those in and added in some of the other large ones, those numbers wouldn't change. We've tried to knock out some of the higher ones and some of the lower ones and try to come up with a good peer average. And as you can see, even at $13 where we are now, we're still trading at about 1/8 of what the averages are. So again, we believe that our inflection point is right now. Key takeaways, we are, again, in e-commerce enablement. It's been enhanced by the unfortunate state of things with COVID. But as we start to look a little bit better in terms of the vaccine rolling out and getting back to our previous normal lives, we'll still be very much conducting business in our lifestyles by way of the mobile phone and the computer. And so our business is just now starting to take off, and we expect that to continue to do so. If you take time to look at our management team and our board of directors, which has grown just this year alone, you'll see that it has all the hallmarks of much larger companies. You'll see expertise and tenure of our management team and board that come from very large enterprises, and what they all bring collectively to Logiq is the ability to take us from where we are now well into the future and into a realm where we can also become a billion-dollar valued company. We have catalysts in place for valuation expansion. There's been some news recently about our initiative to undertake a going public transaction in Canada, which is the home of Shopify and a number of other multi-billion-dollar valued tech companies which are directly in our space, and then circle back to the New York Stock Exchange. We've publicly stated that those are in process now, and we'll start to announce more surrounding those in the near term. We are, again, on track for record revenue growth this year and certainly onwards. And the evolution of our business by adding the ad tech and martech component, thereby creating higher growth, is firmly in place. So with that, I'll end with our public peer comp slide again and open it up for Q&A. Jack?
Yes. Okay. Brian. You hear me, right? Okay. Perfect. Let's go to some questions that we're a little bit short on time. I want to ask you first, though, what's happening with the deal you announced with Indonesia, the Social Security Administration? There's like millions of people, fintech deal. For anybody new, just give us a snapshot of what the deal is and give us an update.
Sure. So last month we announced the partnership with the Social Security Administration in Indonesia. It's a government organization. They've got nearly 50 million members. That's a little over 20% of their population base. They're growing it year over year. They've also implemented pension plans and payroll services to other groups as well. So what you see is a base of 50 million members that they administer savings and payroll services to. They're opening that up to us to provide mobile services to that customer base. And that will all be through a mobile app. And our pilot project with them, which is already underway, is their 6,000 employees. We just recently announced that that's already in process. What you'll see on the heels of that is the entry into phase 2. And phase 2 is comprised of 5 million delivery drivers. So actually the same folks who make deliveries and do ride sharing within Indonesia and work for 2 unicorn valued companies, Grab and Gojek, they are part of a collective called Garda that is, it's actually in excess of 5 million drivers in ride sharing folks. And what we'll do is, as part of phase 2, we'll be layering in the same type of services. So they'll be able to borrow against savings. They'll be able to take pre-payroll loans for less than a month. We'll also be layering in our e-wallet and other logistics-based services. And then phase 3, which we expect to launch in Q2, will be broaching the entire 50 million member base for the Social Security Administration.
Okay, so so this guy's asking, when is the stock going to $20? So I'm going to get right to the bottom line here, Brent. What does this mean for revenues? This fintech deal.
Okay, so it's being modeled out now. What we've done is we've taken call it a better case scenario of 15% traction and a low estimate of 2% traction. We factored in two components. One is longer term loans, one are shorter term payday loans. What we came out with is on the 2% penetration, it comes out to being additive of around 5 million in revenues net to us on the low end. And on the high end at 15%, it could be significantly more, around 25 million. And we believe that is a relatively conservative approach. So those numbers have not been added into the revenue targets that we forecast for next year and the following year. We're trying to view this as somewhat of a bonus, if you will.
So that's worth basically. Okay, I'm going to answer this guy about the stock. So basically, that stuff is worth let's say 20x at fintech revenues. I mean, again, compared to the peers, you're talking about let's call it 200 million market cap additional on top of what you have now. So what is that? That's $20 roughly.
Just for that component alone, if you take the metrics, yes, I believe so.
Okay. Let's see here. We're going to try to run through a couple of questions because we're going to be tight on the schedule here. So D is asking you guys are partnered with SC. Don't they have their own digital payments, and how do you work with them otherwise?
Sure. Okay. You're correct, D. What we're doing with C is their ShopeePay platform is indeed an e-wallet, and so the partnership with them is for delivery services. So our ATOS Go business unit in Indonesia has been making foot-based deliveries since last fall. And so when C started to branch outside of their own ecosystem of products and services being enabled by their e-wallet, they looked to us to try out a pilot program where our delivery people on foot are making deliveries of food and other grocery items to their members who use their e-wallet. And all along, our e-wallet has been agnostic, and so is our food delivery platform. So anyone who uses ShopeePay or any of the other e-wallets in country can pay for those deliveries with their own e-wallet. So it doesn't limit us just purely to ours. So this opens it up significantly because ShopeePay accounts for about 60% of all e-commerce transaction payments within Indonesia.
Okay, Brent. So you I think there was a Form D file. You recently bought some shares. You bought 10,000 shares the other day?
I did, yes. This week I paid $10.37 a share for 10,000 shares.
Okay, you have good timing. Stock is up now.
Oh yes, yes. I was very lucky.
What is so? How many shares do you own now? Because I mean, like, are your interests aligned with the shareholders, basically?
They are. I currently own about 250,000 shares directly. I also hold shares in my kids' names, and our entire management team over the past 5 years has actually foregone market rate salaries for shares. And just to put it in perspective, when I started 6 years ago, I outlined a very low salary for the foreseeable future. And even last year, I made quite a low salary, but I was supplemented in shares. And the same holds true for our entire team. And incidentally, we've also initiated a lockup of an additional 2 years on top of normal affiliate lockups. So we're although we're able to purchase shares in the open market, we do so with the knowledge that even those shares purchased carry a 2-year lockup. So, I'm in for quite a long haul. What is our anticipated exit? We believe that if positioned properly, we could exit through a liquidity event of an acquisition.
Okay. Assuming at higher prices than where you are now.
Hope so.
Okay. Kevin is asking, when will revenue from GoLogic, PayLogic, Fixel, the recent, be part of Logiq earnings, and what will be the estimated contribution?
2021.
Okay. When will the revenue from? Oh, can you see this questions now, Brent? You see the screen now?
I can't actually, but
okay. Hang on. Okay, so I'm going to do this. How about now? Can you see it?
I'll have to do my slides if that's okay.
Pull out the slides. It'll make it easier if we. Yeah, I think that.
Sure.
Okay. I didn't realize you could.
Okay. When do I think the revenue generated from the partnership with KMSB, Tech Mahindra C Limited, will be reflected in Logiq earnings? Okay. Definitely 2021, because we've only recently started the process to take a percentage where we are majority owners, and we'll be consolidating those numbers in going into next year.
Okay, we got Phil asking, nice revenue growth projections. You mentioned about gross margin improvement. Should we expect slower growth on revenue because some of the initiatives taken to improve margins?
That's a good question, Phil. Thanks. So I wouldn't call it slower growth. Actually, what we did in Q3 and what we're doing in Q4, and we've actually publicly stated this, on our historical business of Create App, which we have rebranded as AppLogic. When we first started out, we signed predominantly white label partnerships, and those partnerships ended up putting us in about a 17% gross margin range. And so as part of that, what we've done is we've discontinued a number of the white label partnerships and started digital marketing on our own. And so the analogy of the hockey stick is already underway, and we've highlighted that. So what you'll see is an impact. What you saw is an impact Q3 and 4. But as we head into 2021, Q1 and Q2, I would not call that slow growth at all. I'd call that a transition into both higher revenue and certainly higher gross margins.
Okay. Let's see. I think we have time. We're going to ask one more question, and we're going to jump into the next presenter here. So let me just see what we have. Phil is asking about strategic partnerships. Can you provide more color what you'd be looking for in terms of partnerships?
If you have some, Phil, certainly reach out to us. I would say that there's two distinct candidates. In terms of emerging markets, what we've just signed in the past few months would be representative of the type of partnerships that we look for or are in current discussions with. So generally larger multinational tech companies that either have a presence in the region or have a presence in other emerging markets and are interested in the regions that we're in. So if you look at C, you look at Tech Mahindra, you look at KMSB, they serve very large markets. And so what we're doing is we are taking our historically smaller platform and enhancing it by the partnerships with much larger companies in order to scale up to their level.
Okay. Kevin is asking, what's happening with the NEO listing? When is that going to happen? When will that be? Dates?
Okay. I'm a little limited on what I can say, and that is primarily because of sensitivity around the regulators in Canada. One thing that you don't want to be seen as doing is what's called pre-marketing, going into a going public transaction. So there's only a certain amount that I'm able to say. We have, through our shareholder letter, said that we've engaged an investment bank. We did not say who it is. We'll be free to do that when we file with the regulators, which we anticipate being very soon. One other thing I can say is that the NEO has committed to defaulting to the regulators. So upon going effective by the regulators, which is exactly the same as here in the U.S. with the Securities and Exchange Commission, when you go effective and you go public, the exchanges generally go along with that, and they do not have their additional review. So they would not be performing an additional review. They would basically be saying, okay, you guys are ready to get up and trading.
Okay, so Brent, let's kind of wrap up with what else can we expect? Can we expect any kind of major news into the end of the year, first weeks of January, as we head into this last stretch? Yes.
You can. I would say that there will be updates on initiatives that have been undertaken recently because everything's been moving very quickly. And I know that our current shareholders and anyone new watching us are eager to hear those updates. And we will certainly talk more about enhanced discussions around strategic partnerships and revenue generating opportunities as we start to finalize them.
Okay, Brent, last question, which we have to ask. It's a very important. In your opinion, top 3 reasons why investors should consider Logiq right now.
Sure. I think going into the whole due diligence issue again, look at our board and our management team and what our respective experience base and tenure have been at much larger companies and how we're positioned in terms of the depth and breadth of those teams. Secondly, I'd say look at the partnerships and customers. Although we are a smaller company in terms of market cap, I think that the type of partnerships that are indicative of much larger companies exist within our umbrella. And then third, look at our valuation. I mean, even at $13 a share, we're 4.4 times revenues, and our peer group is 33 times revenues.
Okay, Brent. On that note, I'm going to put up this thing over here. 10 baggers only. That's our motto here. So we expect you to deliver.
Okay.
Immediately. Our audience is very impatient. We have a lot of millennials here. They want things like now. They can't wait 10 months for a stock to go 10x. They got to have it by Thursday.
I'm doing my best, guys.
Okay, Brent, we're going to catch up with you next time you have news, and we'll see you on the next live stream.
Wonderful. Thanks, Jack. Thanks, everyone.
Thank you, Brent. Okay. Let's get ready for our next presenter. Again, we're looking for 10 baggers only here. We're going to find out if our next presenter is going to be a 10 bagger stock. Let me just pull this. Let me get things set up for you right now. Okay, hang on a second. Okay, we have ICAN. Let me just get the banner up. And there we go. Okay, now we need to have Brandon here. Brandon, you're there.
Jack, how are you?
Better than ever. How are you doing?
Can't complain. It's another sunny day in paradise.
Fantastic. Oh, you're in where are you? Are you in Northern or Southern California right now?
I am in lovely Southern California today.
Okay, excellent. So we're gonna be showing. You're gonna be giving a little presentation. We'll open up for Q&A, right?
Sounds great.
Okay, let me see if we have the slides ready to go. Oh, there we go. Okay.
There we go.
Let me just make sure we get everything functioning here properly. We got okay. Looks like we got a lot of people here in the audience. So let me do a quick intro and we'll jump in, and then I'll come back for the Q&A. So welcome everybody to Wall Street Reporter's next Super Stock live stream for today, December 17th, 2020. Today we have a returning presenter. We have a Brandon here from Icanic Brands, the Tesla of cannabis, ICAN, ICNAF. And we're going to find out if this is going to be our next 10x to 100x stock. The stock has already moved up a decent amount. We haven't seen that massive parabolic move yet. So Brandon, we're counting on you. You got to catch up here. We got to catch up to $5 stock soon. So
there you
go. With that said, I'm going to turn it over to you.
Okay.
And we'll share the story. And then everybody in the audience can please ask your questions. Again, it's your questions that make these events special. So watch the presentation, ask your questions, and then decide for yourself if Icanic Brands is going to be our next 10x winner. Brandon?
Sounds great. All right, great. So yeah, thanks for having me on again. Obviously, I am the CEO of Icanic Brands, and the goal today is to kind of update the audience just on kind of where we're at, and then happy to answer any questions that anyone might have. So with that, so who are we? Icanic is a leading California cannabis company, right? We are focused on the largest market, the most competitive markets with the most discerning customers. The California market in 2019 was $3.1 billion just on the legal side, right? There was another $8.7 billion in illicit sales. In 2024, the projection is that the California market will kind of flip and that it'll move to almost $7.2 billion of legal sales, right? So our belief is that if we can own and dominate the largest market in the world, obviously, as federal legalization continues, we'll be very, very well positioned to expand the brand from a geographic footprint. So obviously here, obviously federal legalization has been a huge component to the story. As we've seen with the most recent election, there was a change in government. 4 states from a federal position or from a recreational position passed, another did so on a medical basis. So, we're seeing it kind of really in front of our eyes, right? This is a real tipping point for the cannabis industry. And again, for us, we believe that if we are focused on the largest market, as federal legalization becomes more and more of a reality, it really just provides a tremendous opportunity for us and our shareholders. Some more stats here on kind of the market data that everyone's seeing. Obviously, cannabis is changing again very quick, the adoption of it. And so again, we're very excited to be well positioned for that kind of growth. So, what makes Icanic interesting, right? So as I mentioned, we have a California focus, again, that is purposefully done. We don't want to be everything to everyone, right? We want to have a very narrow focus and really excel on our kind of value proposition. Obviously, we have a strong brand portfolio. It's led by our wholly owned company, Ganja Gold, which is a leader in the category of infused pre-rolls in California. So it gives us a tremendous advantage when it comes to not only opening doors but really kind of growing this portfolio. Another component for us that's hugely important is our focus on gross margins, right? So for us, the gross margin portfolio is really the foundation of our business, right? We know that we can kind of dial up SG&A and dial up growth, but frankly speaking, without a foundation and without a superior gross margin profile, it really leaves us vulnerable. And unfortunately, we've seen a lot of our friends and competitors in the industry that just don't have that focus, that kind of ride the wave up and then unfortunately ride the wave down as quickly as they rose, because every product that they're selling, they're kind of losing money, right? So for us, building that foundation around a strong gross margin portfolio has been a major theme for us. Another investment highlight for us is our statewide distribution, which I'll touch on. We're widely distributed in the state of California, which again gives us a huge advantage. Technology and automation, I'll touch on that as well. But we really believe that, and especially looking at other industries, right? You look at beverage, you look at all sorts of food, all sorts of industries, innovation, efficiency, increased margins. A lot of that is driven by technology and automation. And so for us, we're looking at a space where, there hasn't been a whole lot of automation and technology improvements, right? And so the more that we can kind of bring that component to the industry, we think that it'll just kind of continue to further position and set us up for the future. And then the last topic is obviously, we are very well structured for growth, right? Whether that be accretive acquisitions, whether that be organic growth, the platform, the foundation is now built, and 2021 will be a year of growth for us. So with that, obviously in California, we're vertically integrated. We have a 13,000 square foot cultivation facility located in Sacramento. We're currently operating out of a 2.7 thousand square foot manufacturing facility in Oakland. We will be moving. We're very excited to be moving about 20 miles north of Oakland. The site is obviously much larger. It's also in a city tax-free zone, which adds a lot of benefits to our overall focus. And then, with that obviously comes our ability to house more technology. And so we will be delivering our second automated pre-roll machine, which I can touch on later, in that facility as soon as we're kind of up and running, which again should only increase the overall production capacity, manufacturing capacity for us. We are set up in Nevada as well. So Nevada will be kind of the second state that we really kind of venture into. Obviously the goal is California, but not wanting to kind of stay stagnant. We have set the groundwork in the foundation. In Nevada, we have a cultivation facility. We have a manufacturing facility. I think more importantly, it's all owned on a 1.5 acre piece of real estate that Icanic owns outright. And so as we kind of continue to grow and kind of dominate California, we will be looking at Nevada to replicate that model and really kind of take advantage of, a lot of the cross-selling opportunities that we see between the two states. So, what is kind of the portfolio today? Ganja Gold is obviously one of our leading brands, right? It's the one of the category leaders in the California infused pre-roll space. Again, gives us a tremendous opportunity, tremendous positioning within the market. The Tarantula is kind of a worldwide known product, and so it gives us a huge advantage as we open new retail doors, as we look to eventually grow into other states. Being able to have a category leader in anything that you do is obviously a huge win. Kind of a recent stat, obviously a recent award that we received from LeafLink, naming us as one of the fastest growing pre-roll companies in the nation, which is a huge honor for us and the entire team. Another one of our companies within our brand portfolio is Taylor's. Taylor's focuses on the volume segment of the market, right? So where Ganja Gold really kind of speaks to this kind of connoisseur level. It's both premium in price and in potency. We really saw through our data-driven analytics and kind of being on the ground that, we saw a huge opportunity to take advantage of the lower end of the market, the volume market, where most of the volume was being done. We were able to kind of quickly bring a brand to market in Taylor's. Taylor's, again, focusing on that same high gross margin profile, but delivering, a $2.75 wholesale product, 1 gram product to the market has been a big win for us. Again, leveraging our same manufacturing capabilities, leveraging our same sales distribution. It's been a very seamless process for us and one that, we think will have tremendous growth for us going forward. So, I spoke to, this idea that one of our big focus is this idea of a superior gross margin profile, right? And so for us, what does that mean? That means that we are targeting 50% gross margin on all SKUs that we bring to market. Our belief is that if we have this foundation in place, again, it'll set us up very well for growth in the future. And so for us, it's critical. But I think more importantly, how does, it's great to say that you have this target, but how do you get there, right? And so for our company, this target is really based on our 3-pillar model, right? And so what are those 3 core pillars? How do they basically get us to this intended goal of kind of a 50% plus gross margin on all SKUs? It's very simple. The 3 pillars for us are technology, sales platform, and vertical integration. So for us, this is kind of, at the core of everything that we do kind of day in and day out, all kind of driving towards this idea that we are targeting, again, a 50% plus gross margin profile on all of our SKUs. So technology, right? So I touched on it a little bit earlier. Automation technology, is a huge component of our business. We think it's kind of severely lacking in the industry as a whole. And we believe that it's one of the only ways that this industry is going to continue to drive up gross margins, create more efficiency, and have the ability to scale, right? And so to that end, we partnered with some leading engineers out of Silicon Valley. These guys are building one-of-a-kind technologies for the likes of Tesla, Genentech, Johnson & Johnson. We were able to convince them to co-develop an automated pre-roll technology with us. This automated technology basically makes a pre-roll from kind of A to Z. And so, while that may seem easy, a lot of the viewers out there, I'm sure, can point to cigarettes and, beverage and bottling and canning lines and think, it's a very easy process. In cannabis, it's actually very difficult, right? And so if you think about automation, technology and automation, the output is only as good as the consistency of the input that you put in, right? And so when you take cannabis, for example, the properties, the consistencies, the textures are all very different strain to strain. And when you're trying to bring hundreds of different strains within your product to market, you're constantly having to evolve. I would say even the same strain grown at different types of the year can have very different properties, right? And so the biggest challenge in kind of trying to create this technology from scratch was, how do you get a piece of technology, a piece of automation, machinery that can take a wide array of inputs and create the same consistent output? And so that's been the challenge, and we are very excited to kind of bring that technology and that automation process to life. We brought it into our manufacturing process in kind of calendar Q2 and Q3 of 2020, and are now successfully have integrated it into our overall manufacturing process, again, with the idea that, the goal is to increase gross margins, increase efficiency, and I think most importantly, allow us to produce at scale a consistent product for the consumer time and time again, right? Consumers want consistency. They want to know what they're getting. I think that in pre-rolls, when you have a large manual labor force, right, there's a lot of opportunity for error, right? And so just like with anything, if you can leverage technology and create that kind of same consistent output, the end result will be that the consumer will get that same experience time and time again that they're expecting. So technology is a huge component of our business. Again, we recently announced that we have a signed LOI with THC Engineering, who were our partners in kind of co-developing this technology. For us, being able to acquire that company, that team, was a huge advantage win for us. It allows us to not only continue to improve on the existing technologies, but also look at developing additional technologies as we look to kind of expand our business, again, with the goal of creating kind of that 50% plus gross margin target on all SKUs. The next kind of core pillar for our business is our sales platform, right? And so we're in 375 plus doors within California. We have a 7-member sales team across the state. 5 are out in the field. 2 are headquartered in Oakland, doing inside sales, the digital marketing, and the relationship between us and our partner Navis, who handles all of our distribution. The sales platform for us, is huge, right? I think, unlike a lot of industries, let's take food, for example, right? If I sign up a Whole Foods or a Kroger or a Vons or whoever the case may be, that single yes from the buyer affords me hundreds, if not maybe thousands of retail doors. In California, it's very different, right? Maybe the largest single retailer has 5, 6, 7, 8, retail doors, right? But most of these accounts are 1s and 2s, right? And so it's very difficult and presents a huge barrier to entry to get widespread penetration throughout the state. So how do you do it? Frankly speaking, it's a lot of blood, sweat, and tears, right? Our sales team is calling on these accounts, visiting these accounts on a daily, weekly basis, right? They've really established their relationships with the buyers, the bud tenders, the real decision makers, at these accounts. And when you're dealing in 1s and 2s, it's really tough to kind of replicate that, right? And so what does that do for us? It obviously gives us a tremendous advantage against our competitors when we're looking at selling our own brands. But I think most importantly, it also sets us up very well for the future, right? So as we look to launch additional brands, additional SKUs, even look at our accretive acquisitive model, I know now that we have a widespread sales team that can give us distribution across the entire state very quickly, right? So now I'm no longer concerned if a brand that we acquire, only has a presence in Northern or in Southern California. The sales platform, the sales team that we've built, is a huge advantage for us as we look to not only take advantage of the opportunities we have today, but also look at kind of 2021, which will be, in our view, a huge growth year for us. So again, sales platform, a huge pillar of our business. Kind of gives you an idea of population here, number of shops, some of the accounts that we're in. It's something that we're very proud of. The last kind of core pillar for us is our vertical integration, right? So, when I say vertically integrated, we are vertically integrated now from cultivation onto package labeling and testing, right? And so for us, I'll speak mainly about the vertical integration that we did in 2020 down to the cultivation side, right? So historically, we were spending anywhere around $1,800 a pound for our premium indoor product, right? And so based on our vertical integration and kind of owning that supply chain within cultivation, now our kind of cost of good per that pound is $1,000 to $1,100 a pound, right? And so we've decreased the single largest cost of good input by almost 50%. It's been a tremendous win for us, and certainly couldn't be prouder of our cultivation team. They're putting out some amazing product, and it's really helping us in every aspect of our business. The thing that we didn't foresee was, the rising flower costs within the past kind of couple of quarters, right? So now that same pound of premium indoor that was going for $1,800 a pound is now $2,500, $2,600, $2,700, right? And so, for those brands that were not vertically integrated, they are really struggling, right? You're having your single largest cost of good input increase now by almost 50%. But yet cost of finished goods at the retail level, those prices haven't increased at all, right? And so where does that margin or that lack of margin go? It gets absorbed by companies who are not vertically integrated, right? They're having to pay 50% more for their largest cost of good input, but yet not being able to charge a penny more for the finished good after taking the manufacturing risk at retail. So for us, again, a vertical integration has been a huge win for us, not only to reduce our own costs significantly from what we were paying in kind of the bulk market, but now also being able to take advantage of this price fluctuation by now actually selling any excess bulk flower that we have and using it as a revenue generator for the company. So again, our company, we think about the space a little different. We are highly focused on margins. We back up that margin thesis with this 3 core pillar model that we have. And we think that not only does it position us very well today, it really kind of sets us up for, what we think is going to be a very exciting future, right? And so to that end, what does the future look like for us? And how do we kind of look at 2021 as a year of growth, now knowing that we've kind of built this foundation? So the first is obviously continued California revenue growth. We're going to be continuing to open up doors on a daily, weekly, monthly basis, adding more accounts that we can ultimately sell our portfolio of products to. We're going to continue to reinforce the brand Ganja Gold as a category leader in the space. We'll be launching half grams in the kind of coming couple of quarters, right? We think that that's a huge opportunity. Currently, we sell 1 gram, mainly 1 gram units, right? 1 gram units in California, make up about 30% of the market. So there's a huge opportunity for us to kind of attack that remaining, call it 70% of the market. We're also going to be launching, multi-packs, right? And so again, historically, we've sold single 1 gram units. but launching multi-packs, again, singles only represent about 50% of the California market. So again, it's a big opportunity for us for growth. We're also going to be continuing to cross-sell our Taylor's brand with our existing accounts, right? And so Taylor's, we think, is just getting going, and we think that it's a huge opportunity to, again, leverage the existing sales platform that we already have in place and kind of further bring that brand to the wider spread market. And then the last component of kind of the existing revenue growth is we're going to be launching a white label business, right? And so for us, knowing that we have this 3-pillar system in place, we've had tremendous inquiries about, can we manufacture pre-rolls for other brands? Can we really drive this white label business? When I think of historically in other industries, white label can be, low margin and very unsexy, right? For us, we think that leveraging our technology, leveraging our 3-pillar system really allows us to really kind of target that kind of high 30s, low 40s% gross margin in a white label business. So it really provides us a pretty unique opportunity. Again, manufacturing pre-rolls can be very tough for a lot of folks, hence why we've had kind of this tremendous demand. But with us, leveraging our technology and leveraging our automation allows us to manufacture quicker, more efficiently, and cheaper than most. And so we're excited to take advantage of that opportunity. I think the other component that becomes very interesting for us is, working with a lot of the largest brands in California, a lot of the largest brands that want to enter California. If I can kind of control that manufacturing process in the supply chain segment, we now kind of embed ourselves into the supply chain of some of the largest companies, in California, right? And so I think it gives us a very unique position, a very unique seat at the table. The second kind of key driver for us is going to be our brand acquisition strategy, right? And so, we are looking at opportunities, brands that are doing $200,000 to $500,000 top line a month. I don't really care about how much money they're making. I don't really care about their gross margin profile. I'm looking for brands that have strong customer awareness and decent shelf space that I can basically acquire. I can wipe out their SG&A because I have all the SG&A components already in-house. I have the sales team in-house. I have the distribution model in-house. I'm also not as concerned about their supply chain because the goal would be to bring them into our own supply chain, targeting that 50% plus gross margin profile. So their existing gross margin profile doesn't become as big of a concern. And as I also mentioned, I think the other component is I can give them widespread distribution day one, right? So these transactions look very accretive for us immediately. And again, we think that our positioning in the market, having been a part of the industry for a long time, gives us tremendous credibility when talking with some of the other legacy brands. And this idea of really kind of consolidating, leveraging our platform is going to provide us, with a tremendous growth opportunity in 2021, now that our foundation is built. And then the third kind of key pillar is obviously, what do we do outside of California after, we've quote unquote perfected the model? Obviously, as I mentioned, Vegas will be, Nevada, Vegas will be the next, kind of real opportunity for us. We're vertically integrated in the state of Nevada. We have all the pieces in place. We have a legacy brand that we're kind of currently selling there. So again, Nevada will be the second home for Icanic as we kind of continue to build out California. And then, we'll look at opportunities as we go, right? But I think for us, it's really kind of, how do we maintain that kind of key focus? We want to stay focused on our gross margin profile, all really being driven by, our kind of core pillars. And so we are very excited about, what 2021 holds for us, after a really a great 2020. And then, here's some kind of basic information regarding our kind of capitalization and our Q3 performance. But happy to answer any questions that the audience might have or expand on any other aspects.
Okay, let's get into some Q&A. We got a bunch of questions coming in here. So let's start with a good one. This is related to the acquisition you just announced. Okay, so 2 Mil is asking, how many pre-rolls can one machine make per hour now? And is it possible to scale that number per hour higher in the future? And what's the current gross margin on in-house pre-rolls?
Yeah, so right now we have a machine rate of about 1,000 pre-rolls an hour. Part of the acquisition strategy of acquiring THC Engineering, which we announced the LOI last week, was the goal is for them to obviously be able to improve the technology, right? Obviously, any sort of improvement, 20, 30%, 50% can make a huge difference in the gross margin of all of our products. Obviously, we have a wide array of SKUs, and so the gross margin target is always 50% plus. So it's kind of this basket of a portfolio, and so the gross margins are all kind of around that kind of key target, if not higher. And then from the standpoint of how do we grow, right? Obviously we have one machine currently in operation. We'll be bringing online our second machine as soon as kind of we move to Concord. So we're very excited about that. And that effectively doubles the production capacity, right? So the idea right now for us, unfortunately, or fortunately, I guess, is that we have a demand problem, right? We cannot produce enough products based on the demand for our products, right? So having to bring on a second machine, having to move to a larger facility that's almost 3 times the size, and then also looking at a second and third shift is our ways that we are actively working quickly to kind of solve this demand supply imbalance.
Okay, so that's a quality problem that you have.
It's one that's it's kind of a company's dream, right? That to have more demand than you can kind of possibly supply.
So what's the plan when you have these the ganja rolling machines cranking full steam?
Yeah.
What's now that you're acquiring kind of the technology, the manufacturer, the whole thing? What is the real plan? Are you going to? I think people have asked, are you going to be licensing the technology, selling machines, contract? Where do you see as the big kind of opportunity this year? Like, because this seems like a real inflection point right now.
Yeah, no, it's a tremendous inflection point. I think, first and foremost, we want to continue to own and dominate California, right? So as the production capacity needs increase, whether that be through our own existing portfolio, whether that be through the portfolio of brands that we acquire, or even if it comes by way of our white label business, right? We think that's going to have tremendous demand for our manufacturing capabilities. The idea is to increase the number of machines that we have in California to really meet that demand. The second component would be looking at Nevada and how do we kind of expand that market by leveraging our technology as well. And then I think beyond that, it really is, we're going to take, it really kind of state by state, right? We think that we have a tremendous advantage in the marketplace. And the goal for 2021 will be how do we capitalize on that while still not kind of losing our focus of really being a California first company.
Okay. Related question. How much sales are you expecting in Nevada?
Yeah, we haven't released kind of the expectation yet. A lot of it is driven by kind of the larger factors, right? And so, we're constantly evaluating, how quickly the state of Nevada, obviously Vegas, which is a tremendous tourist destination, right? So a lot of that is kind of fluctuating. But I think the good thing is that we are well positioned in the state, right? We own a 1.5 acre piece of real estate. We have the manufacturing capabilities, the cultivation licenses, all on property. And so we are very well positioned, as Nevada and more importantly, Vegas kind of come back on live.
Okay. Alan's asking, I don't know if you covered this. How many machines are running right now? What's the schedule? Full-time, half?
Yeah. So we have, currently we have one machine running. Again, we'll be bringing the second one on here very shortly. And currently we're only operating a one shift, which is, kind of the traditional 8-hour shift. And so 2 things that will happen when we move to Concord, right? Obviously, the square footage of the manufacturing space will dramatically increase, which will provide us tremendous output capabilities. But then we'll also work towards a second 8-hour shift and then eventually a third, right? I think with technology and automation, because we don't need a a large labor force to operate these machines, the beauty is you can kind of move to a 24/7 model much quicker than if you had, 60, 70, 80 people that you had to kind of manage, right? And so, the goal is to have it, eventually get to a 24/7 model where we're able to kind of meet that demand that we have.
Okay, Jeremy's asking, will the same machine be able to make both 1/2 gram and 1 gram rolls?
Yeah, it will. Again, we're very excited for, the launch of our 1/2 grams. It'll be a bit more than 0.5, but for I think the audience, a lot of folks know 1/2 grams, right? And so, the beauty of our technology is we can use the same machine to both do, the 1 grams and the 1/2 grams.
Puneet is asking, are you planning to increase your sales force?
Yeah, I think it's we feel very good about where we're at, right? Obviously, I think what's going to change the need is if more and more doors open, right? And so we actually think that, with a lot of the issues that have been caused with, a lot of these states losing tax revenue due to COVID and, all these types of unfortunate situations, a lot of these cities who may have not been open to cannabis in California previously will now consider that as a way to make up the tax revenue, right? So we think that, a lot of these cities that were maybe kind of on the fence are now being forced into a situation where this is the best way for them to make up that tax revenue. And we think that more and more retail in California will come online. And at that point, as more and more doors open, we'll have to address the need of our sales team and kind of look at the coverage. Right now we're good, but we're hoping that we can kind of expand that team based on more and more cities, opening up to retail.
Okay, we have Hammy here asking, would you want to build out more in California to meet demand before expanding it to other states? And what is the plan for manufacturing the machines?
Yeah, so, again, I think the core focus is obviously to meet that demand in California first, right? We have a tremendous opportunity. Again, it's every company's dream to have more demand than supply. And so, we want to meet that supply demand imbalance first and foremost. Whether that be through a larger footprint or whether that be through additional machines, a little bit of that is to be determined. But I think to the second question, we have that manufacturing capability now for machines in-house through the potential acquisition of THC Engineering. And so as we look to expand, we will have that manufacturing capability, whether that be Vegas, whether that be additional machines in California and beyond, right? So, again, big win for us.
Okay. Tumil is asking, so the acquisition of THC Engineering seems to be a big deal. Are there other technologies that are in the pipeline?
Yeah, I mean, it is a big deal for us. I think that anytime you can bring the human capital that this team and this company has, right? You're talking about really one-of-a-kind engineers who are building equipment for Tesla, Genentech, Johnson & Johnson, right? Like, they don't just, large Fortune 500 companies just don't hire anyone, right? They have the benefit of being able to hire whoever they want. And so for us to be able to integrate that team, into our overall team is a huge advantage, right? We're constantly trying to, really be mindful of the idea of marrying California legacy cannabis expertise with, business and kind of professional service and technology expertise from other industries to really kind of give us that competitive advantage. And I think that this acquisition of, not only acquiring THC, but really the team is a huge, is a huge kind of double down on that efforts, right? We just think that these guys are it's tremendous opportunity, tremendous company. And, to the viewer's point, obviously the goal is the pre-roll machine now, but having that team in our back pocket to be able to look at other opportunities as they come up with, really looking at other types of technologies is definitely a focus for us in the future.
Okay, so really, I guess the takeaway today is that ICAN is at this inflection point right now where, your sales are, about to go exponential.
Yeah. I think it's, in many ways, a lot of things are setting up well for us in 2021, right? Our own growth, now that our foundation has been built, we think is we're just at kind of the first inning of growth, right? I also think that we're seeing a lot of excitement in the industry, right? Even kind of the Tilray and EFRIA announcement, right, is providing a lot of excitement towards the industry. We think that people are focusing on this idea of kind of consolidation and improvement of margins, and they're trying to turn these cannabis companies into real businesses.
We're in a cannabis 2.0 right now. So.
It is, and so again, we couldn't be more excited to be kind of at this.
It's very interesting, yeah, because I mean, really, ICAN is kind of the cannabis 2.0. You get the technology, everything else we're in a new world than it was a few years ago.
Yeah. So again, that's why I think 2020 was so crucial for us, really to kind of build that foundation and really position us well as the industry is, in the early days of change.
Okay. So speaking of M&A, you were talking about, you mentioned the, Tilray, of course, the big Tilray announcement. Do you have are you looking at anything right now? Are you looking at any opportunities? What's kind of, do you have an M&A pipeline? What's happening there?
Yeah, we do. Again, I think for us, growth in 2021 is going to both be organic and acquisitive, right? And so, I think having a strong category leader, a legacy brand, gives us a huge advantage when we're talking to folks on the other side of the table who have built legacy brands themselves, right? California is very unique in the sense that, the cannabis industry has been around for a long time, right? And you have a very discerning consumer, right? You have one that is used to the best. And so our ability to sit across the table from potential acquisition targets, having the credibility that we have with kind of a category leader gives us a huge advantage. And so the plan is to really kind of take advantage of that pipeline, our unique positioning within the market.
It's funny you were talking about the California. Yeah, it really is like you gave the example. It's like the wine industry. It's like it's almost related. I guess they are kind of related. Different sides of the people's whatever entertainment.
Yeah.
Medicine, so things are looking pretty good. So let's kind of wrap up here. Let me see if we have any more questions here. No. Okay. So we got inflection point. Okay. Brendan, let's our favorite question, you know what that is going to be right now. Two things. One is news flow. What can we expect coming up, right now? And the next one is what that's going to be.
Yeah. So I think from a news perspective, I think the audience can kind of watch out for this coming quarter. I mean, I think there's a lot of acquisitions in the pipeline. There's a lot of new products that we're bringing to market. Obviously, we'll kind of provide, a firsthand experience and kind of the background on any deals that we do to the audience, right? Kind of giving the story and the background of why it's important to us, right? Really kind of expanding beyond just the headline. And so, that's something to kind of certainly look forward to.
Okay. Yeah, I'm going to bring another audience question. We get a couple people asking why is the black market more profitable, or what, is there going to be an inflection point of the black market going to the legalized market? What do you see happening? Because it's a California big issue there.
Yeah, I think the easiest thing to point to, right, beyond kind of the regulations and beyond the restrictions of the black market that obviously we have in the legal market, the simple one is tax, right? You almost have a 30% total tax rate when you include a lot of the various state taxes and the city taxes. And so even just that makes legalized products almost 30% more apples to apples, right? And so the encouraging thing is that a lot of these cities are really cracking down on the black market and trying to, right? They realize that every sale made in the black market is missed tax revenue for them, right? And so certainly in an environment like we're currently in, where the tax collection wasn't as high as it was prior, I think a lot of cities are beginning to realize the easiest thing they can do to kind of make up that tax revenue is simply by further cracking down on the black market, right? And so as that crackdown grows and grows and grows, really that's just going to shift, again, in kind of 2019, you're talking about almost a $12 billion California market, but yet only $3 billion of that came to the legal market, right? So even just shifting it to a 50-50, 50% legal, 50% illicit, almost increases the would-be 2019 sales by almost 100%, right? So it's a huge, I mean, and when you're talking about billions of dollars, it's a tremendous opportunity for folks playing in the California space.
Okay, so Brandon, our favorite question to wrap up, in your opinion, right now, what are the top 3 reasons why investors, should consider ICAN?
Yeah. So love the question. First, it's our California focus, right? Just like the wine industry, Napa Valley is always going to be a premium to the rest of the market, right? You can grow grapes anywhere you want in North America, in the world, but Napa Valley always holds kind of that premium legacy component to the overall space. And we think that California cannabis is going to have that same component, right? If you can win in California, you can win anywhere. And so again, because we're able to win in California, it's going to provide us a huge advantage for us going forward. The second reason that we're extremely bullish on Icanic is our focus on technology and automation, right? We are really trying to double down on this idea that the only way to get to a higher gross margin profile, have more efficiency, and allow us to scale more, scale quickly and get to market faster is technology and automation. Just like we've seen in every other business, every other industry, without technology, without automation, it makes it really tough to grow and increase margins. So again, automation and technology is a huge component for us. And the last component is this idea that we have the foundation for growth, right? This company, 2020 was the year that we really focused on the foundation, really focused on our target gross margins. And so, you're getting an opportunity now where the foundation is built and it's really primed for growth, whether that be through organic growth, whether that be through our white label growth, whether that be through our acquisitive growth, right? We think that we have a lot of levers that we can kind of pull on to make 2021 a year of growth for Icanic.
Okay, excellent. Brandon, on that note, I want to thank you, and we look forward to hearing more from you again in the future so we can have you, in this 10-bagger club.
Sounds good. Sounds good.
By February or March.
Whatever you want, let us know.
Thank you, Brandon. Thank you, everybody, for joining us, and we'll see you on the next live stream.